Do you want to successfully complete the C237 Objective Assessment exam? Then you are in the right place. Our website provides a list of questions and answers for your success in the C237 OA exam for free. We understand that acing your OA exam can be quite challenging. That's why we provide completely free exam guides and practice questions for you. In this video, we will cover questions from tax doctrines, property and depreciation, business structures, deductions and credits, and accounting methods. So let's get started. 1. What is the primary purpose of the all events test in accrual accounting? A. To determine when expenses can be deducted. B. To determine when revenue is earned and can be recognised. C. To determine when cash payments are received. D. To allow deferral of income to future periods. Can you guess the answer? Correct answer, B. To determine when revenue is earned and can be recognised. Explanation. Option B is correct because the all events test is a fundamental rule in accrual accounting. This test helps a business determine the proper time to recognise income as earned. It states that income can be recorded when two conditions are met. 1. All the events that fix the right to receive the income have occurred. And 2. The amount of income can be determined with reasonable accuracy. Option A is incorrect because while a similar test applies to deducting expenses, the test is most famously associated with the recognition of income. Option C is incorrect because determining when cash is received is the basis of cash accounting, not accrual accounting. Option D is incorrect because while applying the test might result in income deferral to a future period, that is an outcome of the rule, not its primary purpose. 2. Under the community property system, how is income earned during marriage treated? A. It belongs only to the spouse who earned it. B. It is equally owned by both spouses. C. It is split based on individual contribution. D. It is taxed only to the higher earner. Do you know the answer? Correct answer, B. It is equally owned by both spouses. Explanation. Option B is correct because in community property states, there's a special rule for married couples. The community property system dictates that most income or property acquired by either spouse during the marriage belongs equally to both, meaning they each have a 50/50 ownership interest, regardless of who earned it. Option A is incorrect because this describes how property is treated in separate property, or common law states, not community property states. Option C is incorrect because community property is based on equal ownership, not on the proportion of each spouse's contribution. Option D is incorrect because in community property states, each spouse is typically taxed on 1/2 of the total community income, regardless of who is the higher earner. 3. What is the half-year convention in depreciation? A. No depreciation is allowed in the first year. B. Depreciation is calculated based on the exact date of acquisition. C. Half of the annual depreciation is allowed in both the year the asset is placed in service and the year it is disposed of. D. Full year depreciation is allowed in the first year. Can you guess the answer? Correct answer, C. Half of the annual depreciation is allowed in both the year the asset is placed in service and the year it is disposed of. Explanation. Option C is correct because the half-year convention is a simplifying rule for calculating tax depreciation. It treats all personal property acquired or disposed of during a year as if it were placed in service or disposed of in the middle of that year. This means the business can take 1/2 of a full year's depreciation in the first year and the final year of the asset's life. Option A is incorrect because the convention allows for half a year's depreciation, not 0. Option B is incorrect because the very purpose of a convention like this is to avoid having to calculate depreciation based on the exact date of acquisition, which would be more complex. Option D is incorrect because the convention specifically limits the first-year deduction to half, not a full year's worth. 4. Which of the following best describes a personal holding company? A. A corporation primarily earning income from active business operations. B. A closely held corporation generating primarily passive income. C. A corporation that only holds real estate. D. A non-profit organisation that distributes income to shareholders. Can you guess the answer? Correct answer, B. A closely held corporation generating primarily passive income. Explanation. Option B is correct because a personal holding company has two key characteristics. It is closely held, and a substantial portion of its income is passive income, from sources like dividends, interest, rents, and royalties. Special penalty taxes apply to PHCs to discourage their use as tax shelters. Option A is incorrect because a company primarily earning income from active operations is an operating company, the opposite of a PHC. Option C is incorrect because this is too specific. A PHC can hold various passive assets, not just real estate. Option D is incorrect because PHCs are for-profit corporations, and non-profit organisations do not have shareholders to whom they distribute income in this manner. 5. How does the IRS define reasonable in amount for deductible expenses? A. Any expense paid for by a business. B. An expenditure that is neither excessive nor extravagant. C. The amount charged by an employee. D. The amount that exceeds $1,000. Can you guess the answer? Correct answer, B. An expenditure that is neither excessive nor extravagant. Explanation. Option B is correct because for a business expense to be deductible, it must be both ordinary and necessary and reasonable in amount. The IRS defines reasonable in amount as an expense that is not lavish or extravagant under the circumstances. The reasonableness is judged based on what a prudent business person would pay in a similar situation. Option A is incorrect because not all expenses paid by a business are deductible. They must also be ordinary, necessary, and reasonable. Option C is incorrect because the amount charged by an employee does not automatically make an expense reasonable. It is subject to the same standard. Option D is incorrect because the IRS does not use a specific dollar threshold, like $1,000, to define reasonableness for all expenses. 6. What is the key feature of qualified small business stock under Section 1202? A. It must be held for less than 1 year. B. It is stock purchased from a company with assets exceeding $100 million. C. It may qualify for a partial or full exclusion from capital gains tax if held for at least 5 years. D. It is fully taxable upon sale. Can you guess the answer? Correct answer, C. It may qualify for a partial or full exclusion from capital gains tax if held for at least 5 years. Explanation. Option C is correct because Section 1202 of the Tax Code provides a significant tax incentive for investing in small businesses. If an investor holds qualified small business stock for more than 5 years, they can exclude a large portion of the capital gain from the sale of that stock from their federal income tax. Option A is incorrect because the stock must be held for more than 5 years to receive the exclusion benefit. Option B is incorrect because to be a qualified small business, the corporation's gross assets must be $50 million or less at the time the stock is issued. Option D is incorrect because the primary benefit of QSBS is the potential for a significant tax exclusion, making the gain not fully taxable. 7. What does the 1231 look-back rule ensure? A. Taxpayers treat all 1231 gains as ordinary income. B. Net 1231 gains are treated as ordinary income to the extent of previously deducted 1231 losses. C. All 1231 losses are automatically converted to capital losses. D. 1231 gains and losses are carried back 5 years. Do you know the answer? Correct answer: B. Net 1231 gains are treated as ordinary income to the extent of previously deducted 1231 losses. Explanation: Option B is correct because the 1231 look-back rule prevents taxpayers from getting the best of both worlds in consecutive years. If a taxpayer has a net Section 1231 gain in the current year, they must look back 5 years. If they had any net Section 1231 losses during that period that were deducted as ordinary losses, the current year's gain is recharacterised as ordinary income to the extent of those prior losses. Option A is incorrect because 1231 gains are treated as ordinary income only to the extent of the look-back rule. Any excess gain is typically a capital gain. Option C is incorrect because net 1231 losses are generally treated as ordinary losses, not capital losses. Option D is incorrect because the rule involves looking back 5 years to recharacterise current gains. It does not carry back current gains or losses. 8. What is the tax treatment of life insurance proceeds received by a taxpayer who is terminally ill? A. Fully taxable as ordinary income. B. Excludable from income. C. Taxable as capital gain. D. Partially taxable based on life expectancy. Can you guess the answer? Correct answer: B. Excludable from income. Explanation: Option B is correct because if an individual is terminally ill, payments received from a life insurance policy before death are generally treated the same as regular death benefits. This means the proceeds are excludable from the recipient's gross income and are not subject to income tax. Option A is incorrect because these proceeds are specifically exempted from being treated as taxable income. Option C is incorrect because the proceeds are not considered a sale or exchange of a capital asset that would generate a capital gain. Option D is incorrect because this treatment applies to certain annuity payments, not accelerated death benefits for the terminally ill. 9. What is the substance over form doctrine in tax law? A. The IRS can ignore the legal form of a transaction and tax it based on its economic reality. B. The IRS will respect the legal form of all transactions. C. Only transactions with written contracts are considered for tax purposes. D. The IRS does not tax transactions without legal documentation. Do you know the answer? Correct answer: A. The IRS can ignore the legal form of a transaction and tax it based on its economic reality. Explanation: Option A is correct because the substance over form doctrine is a judicial principle that allows the IRS and courts to look past the legal structure of a transaction and focus on its true economic impact. If a transaction is structured in a way to avoid tax but its underlying reality is different, it will be taxed based on that reality. Option B is incorrect because this is the opposite of the doctrine. The IRS is not bound by the legal form if it is artificial. Option C is incorrect because tax law applies to many transactions that do not have written contracts. Option D is incorrect because the absence of legal documentation does not prevent the IRS from assessing tax on a transaction that occurred. 10. Which of the following is an above-the-line deduction? A. Charitable contributions. B. Mortgage interest. C. Business expenses for a sole proprietor. D. State and local taxes. What do you think is the answer? Correct answer. C. Business expenses for a sole proprietor. Explanation. Option C is correct because above-the-line deductions are subtracted from a taxpayer's gross income to calculate their adjusted gross income. Business expenses for a sole proprietor, which are reported on Schedule C, are a classic example of an above-the-line deduction. Option A is incorrect because charitable contributions are an itemized deduction, which is taken below the line. Option B is incorrect because mortgage interest is also an itemized below-the-line deduction. Option D is incorrect because state and local taxes are another common below-the-line itemized deduction. 11. Which tax is specifically designed to ensure that corporations distribute earnings rather than accumulate them without a business purpose? A. Accumulated earnings tax. B. Alternative minimum tax. C. Self-employment tax. D. Estate tax. What do you think is the answer? Correct answer. A. Accumulated earnings tax. Explanation. Option A is correct because the accumulated earnings tax is a penalty tax imposed on C corporations that retain earnings beyond their reasonable business needs, rather than distributing them as dividends to shareholders. The purpose of this tax is to discourage corporations from being used as a vehicle to avoid the personal income tax that shareholders would pay on dividends. Option B is incorrect because the alternative minimum tax is a parallel tax system designed to ensure high-income individuals and corporations pay a minimum level of tax. Option C is incorrect because the self-employment tax is for Social Security and Medicare taxes for individuals who work for themselves. Option D is incorrect because the estate tax is a tax on the transfer of a person's assets after their death. 12. In the assignment of income doctrine, who is taxed on income earned from services? A. The individual who receives the income. B. The individual who performed the services. C. The employer who paid the income. D. The entity that issued the payment. Can you guess the answer? Correct answer. B. The individual who performed the services. Explanation. Option B is correct because the assignment of income doctrine is a fundamental tax principle holding that income is taxable to the person who earns it. A taxpayer cannot avoid tax by simply directing that their earned income be paid to someone else. The fruit must be taxed to the tree. Option A is incorrect because if income is assigned, the person who merely receives it is not the one liable for the tax. The earner is. Option C is incorrect because the employer is the payer of the income, not the one taxed on it as the earner. Option D is incorrect because the entity that issues the payment is simply the source of funds, not the party taxed on the income. 13. What is a Section 1245 property? A. Real property subject to depreciation deductions. B. Tangible personal property or intangible property subject to cost recovery deductions. C. Intangible property not subject to depreciation. D. Property held for personal use. What do you think is the answer? Correct answer. B. Tangible personal property or intangible property subject to cost recovery deductions. Explanation. Option B is correct because Section 1245 property primarily includes tangible personal property used in a trade or business such as equipment, machinery, and vehicles that is subject to depreciation. It also includes certain intangible assets like patents that are amortized. When sold at a gain, the gain is recaptured as ordinary income to the extent of prior depreciation deductions. Option A is incorrect because real property subject to depreciation is generally classified as Section 1250 property. Option C is incorrect because Section 1245 property is specifically property for which depreciation or amortization has been taken. Option D is incorrect because property held for personal use is not Section 1245 property, as it is not used in a trade or business. 14. What does the 1231 look-back rule prevent? A. Taxpayers from converting ordinary losses into capital losses. B. Taxpayers from deferring recognition of 1231 gains. C. Taxpayers from benefiting from capital gain treatment if they have deducted 1231 losses as ordinary losses in previous years. D. Taxpayers from claiming 1231 gains without filing an amended return. Can you guess the answer? Correct answer. C. Taxpayers from benefiting from capital gain treatment if they have deducted 1231 losses as ordinary losses in previous years. Explanation. Option C is correct because the rule is designed to prevent a tax arbitrage situation. Taxpayers benefit when net 1231 losses are treated as ordinary losses and when net 1231 gains are treated as long-term capital gains. The look-back rule limits this by recharacterizing current capital gains as ordinary income to the extent of any ordinary 1231 losses taken in the prior 5 years. Option A is incorrect because the rule does the opposite. It can convert what would be capital gains into ordinary income. Option B is incorrect because the rule affects the character of a recognized gain, not the timing of its recognition. Option D is incorrect because the look-back rule is applied on the current year's tax return. It does not require an amended return. 15. What is the constructive receipt doctrine? A. Income is taxed only when it is physically received. B. Income is taxed when credited to the taxpayer's account or otherwise made available. C. Income is not taxed until it is reported. D. Income is only taxed when the taxpayer cashes a cheque. What do you think is the answer? Correct answer, B. Income is taxed when credited to the taxpayer's account or otherwise made available. Explanation. Option B is correct because the constructive receipt doctrine dictates that a cash-basis taxpayer must report income when it is made available to them without substantial restrictions, even if they have not yet taken physical possession of it. For example, a paycheck available for pickup at the end of the year is considered constructively received in that year, even if not picked up until the next. Option A is incorrect because this describes actual receipt. Constructive receipt means income is taxable before it is physically received. Option C is incorrect because the requirement to report income is triggered by its receipt, not the other way around. Option D is incorrect because income from a cheque is constructively received when the cheque is received, not when it is cashed, assuming there are no restrictions on cashing it. 16. What is the tax treatment of capital gain property donated to a qualified charity? A. Fully deductible at fair market value. B. Deductible at fair market value, limited to 30% of AGI. C. Deductible at cost basis only. D. Not deductible. Can you guess the answer? Correct answer B, deductible at fair market value, limited to 30% of AGI. Explanation? Option B is correct because when a taxpayer donates capital gain property to a public charity, the deduction is generally equal to the property's fair market value. However, this deduction is subject to an annual limitation of 30% of the taxpayer's adjusted gross income. Option A is incorrect because while the deduction is based on fair market value, it is subject to the 30% AGI limitation, so it may not be fully deductible in 1 year. Option C is incorrect because the deduction is typically at FMV. A deduction at cost basis applies to ordinary income property or if the taxpayer makes a specific election. Option D is incorrect because charitable contributions of property are deductible under IRS rules. 17. Which of the following would not qualify as a casualty loss? A. Loss from a car accident. B. Loss from a fire. C. Loss from a flood. D. Gradual wear and tear on property. Do you know the answer? Correct answer, D. Gradual wear and tear on property. Explanation. Option D is correct because a casualty loss must result from an event that is sudden, unexpected, or unusual. Gradual wear and tear, also known as progressive deterioration, occurs over time and is expected. Therefore, it does not meet the definition of a casualty and is not deductible as such. Option A is incorrect because a car accident is a classic example of a sudden and unexpected event that can cause a casualty loss. Option B is incorrect because a fire is a sudden and destructive event that qualifies as a casualty. Option C is incorrect because a flood is another example of a sudden, identifiable event that can lead to a deductible casualty loss. 18. What does the Golson rule state in relation to tax court cases? A. Tax court will always rule based on its own precedent. B. Tax court will follow the rulings of the appellate court in the circuit to which the case is appealable. C. Tax court will make decisions independent of circuit court rulings. D. Tax court can overrule Supreme Court rulings if necessary. Do you know the answer? Correct answer. B. Tax court will follow the rulings of the appellate court in the circuit to which the case is appealable. Explanation. Option B is correct because the Golson rule is a policy of the US tax court. It mandates that the tax court will follow the legal precedent set by the US Court of Appeals for the circuit where the taxpayer's case would be appealed. This ensures consistency within a geographic circuit, even if the tax court disagrees with that circuit's interpretation of the law. Option A is incorrect because the Golson rule requires the tax court to depart from its own precedent if it conflicts with the relevant circuit court's ruling. Option C is incorrect because the rule explicitly requires the tax court to follow, not be independent of, the relevant circuit court's rulings. Option D is incorrect because no lower court, including the tax court, can overrule a Supreme Court ruling. 19. What is a deferred like-kind exchange? A. An exchange where the taxpayer transfers property but receives the replacement property at a later time. B. An exchange where both properties are transferred at the same time. C. A cash sale followed by a later property purchase. D. A property exchange where no taxes are deferred. What do you think is the answer? Correct answer, A. An exchange where the taxpayer transfers property but receives the replacement property at a later time. Explanation. Option A is correct because a deferred like-kind exchange, also known as a Starker exchange or Section 1031 exchange, is a transaction where a taxpayer sells a business or investment property and acquires a replacement property at a later date. To qualify for tax deferral, the taxpayer must identify the replacement property within 45 days and close on it within 180 days of selling the original property. Option B is incorrect because this describes a simultaneous exchange, which is a different type of like-kind exchange. Option C is incorrect because a simple cash sale, followed by a later purchase, does not qualify for tax deferral under Section 1031. The transaction must be structured as an exchange. Option D is incorrect because the entire purpose of a like-kind exchange is to defer the payment of capital gains taxes. 20. What is the main advantage of the cash method of accounting for small businesses? A. It allows deferral of income recognition. B. It is required for all businesses. C. It simplifies tax reporting and aligns income recognition with cash flow. D. It is used to maximize deductions. Can you guess the answer? Correct answer, C. It simplifies tax reporting and aligns income recognition with cash flow. Explanation. Option C is correct because the cash method of accounting is generally simpler than the accrual method. Income is recorded when cash is received, and expenses are recorded when cash is paid. This makes bookkeeping easier and directly aligns the tax reporting with the actual movement of cash in and out of the business's bank account. Option A is incorrect because while deferral can be a result, the primary advantage is its simplicity and correlation with cash flow. Option B is incorrect because many larger businesses, and those with inventory, are required to use the more complex accrual method. Option D is incorrect because the timing of deductions under the cash method is based on when payment is made, which does not necessarily maximize deductions compared to the accrual method. 21. What is a non-refundable credit? A. A credit that reduces tax liability and is fully refundable. B. A credit that reduces tax liability but cannot result in a refund. C. A credit that increases tax liability if unused. D. A credit that carries over to future years if not used. Do you know the answer? Correct answer, B. A credit that reduces tax liability but cannot result in a refund. Explanation. Option B is correct because a non-refundable tax credit can reduce a taxpayer's tax liability to zero, but no portion of the credit will be paid out as a refund if it exceeds the tax owed. It can only offset the tax you owe. It cannot create a negative tax liability that results in a payment from the government. Option A is incorrect because this describes a refundable credit, where any excess credit over the tax liability is paid to the taxpayer. Option C is incorrect because an unused credit never increases tax liability. Option D is incorrect because while some non-refundable credits may have provisions to be carried over, the defining feature is that they cannot result in a refund in the current year. 22. What is the tax treatment of a boot received in a like-kind exchange? A. It is fully tax-free. B. It is taxed as ordinary income. C. It is taxable to the extent of the gain realised in the transaction. D. It is fully deductible. What do you think is the answer? Correct answer, C. It is taxable to the extent of the gain realised in the transaction. Explanation. Option C is correct because in a like-kind exchange, boot refers to any non-like-kind property received, such as cash or debt relief. While the exchange can still qualify for tax deferral, the receipt of boot triggers the recognition of gain. The amount of gain recognised is the lesser of the boot received, or the total gain realised on the exchange. Option A is incorrect because boot is specifically what makes an otherwise tax-free exchange partially taxable. Option B is incorrect because the recognised gain is typically capital gain, not ordinary income. Option D is incorrect because boot is something received that triggers gain. It is not a deduction. 23. Which of the following defines a qualified trade or business for purposes of the qualified business income deduction? A. Any business other than a specified service, trade or business. B. Only businesses related to health, law or consulting. C. Businesses that earn more than $50 million annually. D. Any business located outside the US. Can you guess the answer? Correct answer, A. Any business other than a specified service, trade or business. Explanation. Option A is correct because for the purposes of the qualified business income deduction under Section 199A, a qualified trade or business is broadly defined as any trade or business with two major exceptions: the trade or business of being an employee, and for taxpayers with income over certain thresholds, a specified service, trade or business. Option B is incorrect because businesses in fields like health, law, and consulting are explicitly defined as SSTBs, which are often excluded from being a QTB if the owner's income is too high. Option C is incorrect because there is no such revenue test for defining a QTB. Option D is incorrect because the QBI deduction is for income from businesses conducted within the United States. 24. How does the step transaction doctrine affect tax treatment? A. It taxes each step of a transaction separately. B. It treats a series of related transactions as a single transaction. C. It allows taxpayers to defer taxes on complex transactions. D. It applies tax penalties to incomplete transactions. Do you know the answer? Correct answer, B. It treats a series of related transactions as a single transaction. Explanation. Option B is correct because the step transaction doctrine is a judicial rule that allows the IRS to collapse a series of individual, formally separate steps into a single transaction for tax purposes. If the steps are prearranged and interdependent parts of a single larger plan, the tax consequences will be based on the final integrated result rather than the individual steps. Option A is incorrect because this is what the doctrine prevents when the separate steps are artificial and intended to manipulate tax outcomes. Option C is incorrect because the doctrine is a tool used by the IRS to challenge taxpayer favourable treatment. It does not provide a mechanism for tax deferral. Option D is incorrect because the doctrine is concerned with recharacterising completed transactions, not penalising incomplete ones. 25. What is the Section 179 expense deduction? A. A deduction for charitable contributions. B. A deduction for capital expenditures on tangible personal property used in a trade or business. C. A deduction for real estate investment losses. D. A deduction for business meals and entertainment. Do you know the answer? Correct answer, B. A deduction for capital expenditures on tangible personal property used in a trade or business. Explanation. Option B is correct because the Section 179 expense deduction allows a business to elect to treat the cost of certain qualifying property as an immediate expense rather than capitalising it and depreciating it over time. This applies mainly to tangible personal property, like machinery, equipment and computers purchased for use in a trade or business, subject to annual limits. Option A is incorrect because charitable contributions are a separate type of deduction, typically an itemised deduction. Option C is incorrect because real estate losses are governed by different rules, such as the passive activity loss rules. Option D is incorrect because business meals and entertainment have their own specific deduction rules and limitations. 26. What is the maximum allowable deduction for business gifts to any one individual per year? A. $10, B. $25, C. $50, D. $100. Do you know the answer? Correct answer, B. $25. Explanation. Option B is correct because under IRS rules, a business can deduct the cost of business gifts given directly or indirectly to any one person, but the deduction is limited to a maximum of $25 per individual per year. Any amount spent over $25 for a gift to one person is not deductible. Option A is incorrect because the limit is higher than $10. Option C is incorrect because the limit is lower than $50. Option D is incorrect because the limit is significantly lower than $100. 27. What is the purpose of the Uniform Cost Capitalization Rules? A. To simplify cost reporting for inventory. B. To allocate both direct and indirect costs to inventory for tax purposes. C. To allow businesses to deduct all costs in the year incurred. D. To exclude certain costs from inventory valuation. Do you know the answer? Correct answer, B. To allocate both direct and indirect costs to inventory for tax purposes. Explanation. Option B is correct because the purpose of the Uniform Cost Capitalization Rules under Section 263A is to provide a more accurate measure of inventory cost. These rules require producers and certain resellers to capitalize not only the direct costs of inventory, but also an allocable share of indirect costs that benefit the inventory, such as factory overhead. This prevents the immediate deduction of these costs. Option A is incorrect because UNICAP rules are notoriously complex and generally make cost reporting more difficult, not simpler. Option C is incorrect because the very purpose of UNICAP is to prevent the immediate deduction of certain costs by requiring them to be capitalized into inventory. Option D is incorrect because UNICAP's goal is to include more costs in inventory valuation, not to exclude them. 28. What is the tax treatment of a Section 1231 gain for a non-corporate taxpayer? A. Fully taxed as ordinary income. B. Fully taxed as capital gain. C. Taxed as a capital gain to the extent that it exceeds prior ordinary losses. D. Not taxable. Can you guess the answer? Correct answer, C. Taxed as a capital gain to the extent that it exceeds prior ordinary losses. Explanation. Option C is correct because the treatment of a net Section 1231 gain is subject to the 1231 look-back rule. The gain is treated as a long-term capital gain, but only to the extent that it exceeds any non-recaptured net Section 1231 losses from the previous 5 tax years. Any gain that offsets these prior ordinary losses is recharacterized and taxed as ordinary income. Option A is incorrect because the gain is only taxed as ordinary income to the extent of the look-back rule. Option B is incorrect because the gain is only fully taxed as a capital gain if there are no non-recaptured 1231 losses from the prior 5 years. Option D is incorrect because Section 1231 gains are taxable. 29. Which of the following is a tax preference item for the alternative minimum tax? A. Interest income from a municipal bond. B. Standard deduction. C. Depreciation of personal property under the MACRA system. D. earned income credit. Do you know the answer? Correct answer, C. Depreciation of personal property under the MACRA system. Explanation. Option C is correct, because for purposes of the alternative minimum tax, certain accelerated depreciation deductions are treated as a tax preference item. Specifically, the excess of the accelerated depreciation claimed for regular tax purposes over the amount that would have been allowed using a slower straight-line method is added back when calculating AMT income. Option A is incorrect because interest from most municipal bonds is not an AMT preference item. Only interest from certain private activity bonds is. Option B is incorrect because the standard deduction is not allowed for AMT and is added back as an adjustment, but it is not classified as a tax preference item. Option D is incorrect because the earned income credit is a tax credit, not an income or deduction item that would be considered a tax preference. 30. What is the tax treatment of a Section 1250 gain for individuals? A. Fully taxed as capital gain. B. Recaptured as ordinary income to the extent of excess depreciation. C. Fully deductible as a business loss. D. Taxed as dividend income. What do you think is the answer? Correct answer, B. Recaptured as ordinary income to the extent of excess depreciation. Explanation. Option B is correct because when Section 1250 property is sold at a gain, a portion of that gain may be recaptured as ordinary income. The amount recaptured is generally the excess depreciation, which is the amount of depreciation taken that is greater than what would have been allowed under the straight-line method. Any remaining gain may be subject to other tax rates, like the 25% rate for unrecaptured Section 1250 gain. Option A is incorrect because a portion of the gain is often recaptured as ordinary income, so it is not fully taxed as a capital gain. Option C is incorrect because a gain is being discussed, not a loss. Option D is incorrect because the gain is from the sale of property, not a distribution of corporate earnings. 31. What is a direct write-off method in relation to bad debts? A. Bad debts are deducted in the year the debt is established. B. Bad debts are deducted when they are deemed worthless. C. Bad debts are deducted when they are expected to occur. D. Bad debts are not deductible under this method. Do you know the answer? Correct answer. B. Bad debts are deducted when they are deemed worthless. Explanation. Option B is correct because under the direct write-off method, a business deducts a bad debt expense only in the year that a specific account receivable is identified and determined to be uncollectible or worthless. There is no estimation of future bad debts. Option A is incorrect because the debt is deducted when it becomes worthless, not when it is first established. Option C is incorrect because deducting debts when they are expected to occur is a feature of the allowance method, not the direct write-off method. Option D is incorrect because bad debts are generally deductible for businesses, and this is one of the methods to do so. 32. What is the key feature of MACRA's depreciation? A. It uses straight-line depreciation for all assets. B. It applies accelerated depreciation methods to most tangible personal property. C. It allows deductions only for real property. D. It is available only for assets held more than 5 years. What do you think is the answer? Correct answer. B. It applies accelerated depreciation methods to most tangible personal property. Explanation. Option B is correct because EMACAS is the current tax depreciation system in the US. Its key feature is that it allows for accelerated cost recovery for most types of tangible personal property, meaning larger deductions are taken in the early years of an asset's life compared to the later years. Option A is incorrect because while EMACAS uses the straight-line method for real property, it uses accelerated methods for most personal property. Option C is incorrect because EMACAS applies to both real property and personal property used in a trade or business. Option D is incorrect because depreciation under MACS begins in the year an asset is placed in service, regardless of how long it is ultimately held. 33. Under the economic performance test, when are expenses recognised? A. When the taxpayer's liability to pay is established. B. When all events fixing the liability have occurred. C. When the expense is paid. D. When the underlying activity creating the liability occurs. What do you think is the answer? Correct answer, D. When the underlying activity creating the liability occurs. Explanation. Option D is correct because the economic performance test is a requirement for deducting an expense under the accrual method. It generally stipulates that an expense cannot be deducted until the underlying activity that creates the liability has actually happened. For example, economic performance occurs when services are performed for the taxpayer, or when property is delivered or used by the taxpayer. Option A is incorrect because establishing the liability to pay is part of the all events test, but not the economic performance test. Option B is incorrect because this is the first part of the two-part all events test that must be met before an expense can be accrued. Economic performance is the second part. Option C is incorrect because this describes the timing of deductions under the cash method of accounting. 34. What is ordinary income property? A. Property held for more than 1 year. B. Property that would generate ordinary income if sold. C. Property held for personal use. D. Property exempt from capital gains taxes. What do you think is the answer? Correct answer, B. Property that would generate ordinary income if sold. Explanation. Option B is correct because ordinary income property, in a tax context, refers to any asset that, if sold at fair market value, would result in a gain taxed as ordinary income or a short-term capital gain. Common examples include business inventory, accounts receivable, and capital assets held for 1 year or less. Option A is incorrect because property held for more than 1 year typically generates long-term capital gain, making it capital gain property. Option C is incorrect because while the sale of personal use property can result in a capital gain, the term ordinary income property refers to a specific tax characterization. Option D is incorrect because ordinary income property is not exempt from tax. It is taxed at ordinary income rates, which are often higher than capital gains rates. 35. What is a boot in a like-kind exchange? A. Property received that is not like-kind and may trigger taxable gain. B. A full tax-deferred exchange. C. A refund given to the taxpayer after the exchange. D. An additional deduction. Can you guess the answer? Correct answer, A. Property received that is not like-kind and may trigger taxable gain. Explanation. Option A is correct because in a like-kind exchange, boot is any property or consideration received that is not of a like kind to the property being given up. This includes cash, debt relief, and other non-qualifying property. Receiving boot does not disqualify the exchange, but it does trigger the recognition of taxable gain, up to the value of the boot received. Option B is incorrect because an exchange with boot is only partially tax deferred, not fully. Option C is incorrect because boot is not a refund. It is consideration received as part of the exchange itself. Option D is incorrect because boot is not a deduction. It is something that creates taxable income. 36. What is the main goal of the substance over form doctrine? A. To allow taxpayers to choose the form of a transaction. B. To tax transactions based on their true economic substance, not just legal form. C. To prevent the IRS from disregarding the legal structure of a transaction. D. To simplify tax reporting for small businesses. What do you think is the answer? Correct answer, B. To tax transactions based on their true economic substance, not just legal form. Explanation. Option B is correct because the substance over form doctrine is a legal principle that allows the IRS and courts to recharacterize a transaction based on its economic reality rather than its legal documentation. The goal is to prevent taxpayers from using artificial legal structures solely to achieve a more favourable tax result. Option A is incorrect because the doctrine limits, rather than enables, a taxpayer's ability to rely on the chosen form of a transaction if that form is artificial. Option C is incorrect because the doctrine explicitly gives the IRS the power to disregard the legal structure in certain circumstances. Option D is incorrect because applying this doctrine often involves complex analysis and does not simplify tax reporting. 37. What is the alternative minimum tax designed to do? A. Ensure that high-income taxpayers pay a minimum amount of tax, regardless of deductions. B. Provide low-income taxpayers with a reduced tax rate. C. Replace the regular income tax for individuals and corporations. D. Tax only passive income at a higher rate. What do you think is the answer? Correct answer, A. Ensure that high-income taxpayers pay a minimum amount of tax, regardless of deductions. Explanation. Option A is correct because the alternative minimum tax is a parallel tax system that recalculates a taxpayer's income by adding back certain deductions and preference items allowed under the regular tax system. Its purpose is to ensure that taxpayers with high economic income cannot use these tax breaks to reduce their tax liability to zero, thereby forcing them to pay at least a minimum amount of tax. Option B is incorrect because AMT is aimed at high-income taxpayers, not to low-income taxpayers. Option C is incorrect because AMT is a parallel tax that is paid only if it is higher than the regular tax. It does not replace the regular tax system. Option D is incorrect because AMT applies to a broad base of income, not just passive income. 38. What is unrecaptured Section 1250 gain? A. Gain on real estate that is fully taxed as capital gain. B. Gain on real estate attributable to depreciation deductions taxed at a maximum rate of 25%. C. Gain on personal property that is recaptured as ordinary income. D. Gain on property held for less than 1 year. Do you know the answer? Correct answer. B. Gain on real estate attributable to depreciation. Deductions taxed at a maximum rate of 25%. Explanation. Option B is correct because unrecaptured Section 1250 gain is a specific category of long-term capital gain that applies to the sale of depreciable real property. It is the portion of the gain attributable to the straight-line depreciation deductions previously taken on the property. For individual taxpayers, this portion of the gain is subject to a special maximum tax rate of 25%, which may be higher than other long-term capital gains rates. Option A is incorrect because this specific portion of the gain is taxed at the 25% rate, which distinguishes it from other capital gains. Option C is incorrect because this describes Section 1245 recapture, which applies to personal property. Option D is incorrect because this gain applies to property held for more than 1 year. Property held for less time would generate a short-term capital gain. 39. What is the tax treatment of the dividends received deduction for corporations? A. Fully taxable. B. Partially deductible, depending on ownership percentage. C. Fully deductible as long as the corporation holds the stock for at least 1 year. D. Not deductible. Can you guess the answer? Correct answer: B. Partially deductible, depending on ownership percentage. Explanation. Option B is correct because the dividends received deduction allows a C corporation that receives dividends from another domestic corporation to deduct a portion of those dividends from its income. The deduction percentage is determined by the recipient corporation's ownership stake in the dividend-paying corporation. This mitigates triple taxation of corporate earnings. Option A is incorrect because the DRD makes dividends partially or fully non-taxable to the receiving corporation. Option C is incorrect because the deduction is not always 100%, and while there is a holding period requirement, it is much shorter than 1 year. Option D is incorrect because the DRD is a significant and well-established corporate tax deduction. 40. What is the economic substance doctrine? A. A doctrine that allows deferral of income taxes for any transaction with economic substance. B. A doctrine that requires transactions to have a meaningful impact on a taxpayer's economic position, apart from tax benefits. C. A rule that requires all transactions to generate taxable income. D. A rule that allows taxpayers to deduct losses on personal transactions. What do you think is the answer? Correct answer: B. A doctrine that requires transactions to have a meaningful impact on a taxpayer's economic position, apart from tax benefits. Explanation. Option B is correct because the economic substance doctrine, which is now codified in the tax law, states that a transaction's tax benefits will be disallowed if the transaction does not have economic substance. A transaction has economic substance only if it meaningfully changes the taxpayer's economic position, and the taxpayer has a substantial non-tax purpose for entering into it. Option A is incorrect because the doctrine is a tool to disallow tax benefits, not to grant tax deferrals. Option C is incorrect because the doctrine does not require transactions to generate income. It tests the validity of transactions that often generate losses or credits for tax purposes. Option D is incorrect because the doctrine is used to disallow business or investment-related tax benefits, not to allow deductions for personal losses. 41. What is the tax treatment of non-recaptured net Section 1231 losses? A. They are taxed as ordinary income in future years. B. They are carried forward to offset and recharacterize Section 1231 gains in future years. C. They are taxed at the lower capital gains rate. D. They are not deductible. Can you guess the answer? Correct answer: B. They are carried forward to offset and recharacterize Section 1231 gains in future years. Explanation. Option B is correct because of the 1231 look-back rule. When a taxpayer has a net Section 1231 loss, it is treated as an ordinary loss. These non-recaptured losses are effectively carried forward for 5 years. In a subsequent year, if the taxpayer has a net Section 1231 gain, that gain will be treated as ordinary income to the extent of these prior non-recaptured losses. Option A is incorrect because the losses themselves are not taxed. They cause future gains to be recharacterized as ordinary income. Option C is incorrect because these are losses, not gains, and they are treated as ordinary, not capital. Option D is incorrect because net Section 1231 losses are generally deductible as ordinary losses in the year they occur. 42. What is bunching itemised deductions? A. Claiming all deductions in the same year to exceed the standard deduction. B. Spreading deductions over multiple years to reduce tax liability. C. Combining multiple types of deductions into one line item. D. Claiming only the standard deduction. Do you know the answer? Correct answer, A. Claiming all deductions in the same year to exceed the standard deduction. Explanation. Option A is correct because bunching itemised deductions is a tax planning strategy where a taxpayer tries to time their deductible expenses so that they are concentrated in a single year. The goal is to have enough itemised deductions in that bunched year to exceed the standard deduction amount, thereby maximising their tax benefit. In the other years, they would likely claim the standard deduction. Option B is incorrect because this describes spreading or smoothing deductions, which is the opposite of the bunching strategy. Option C is incorrect because this is a description of how items might be reported, not a tax planning strategy. Option D is incorrect because bunching is a strategy to be able to itemise instead of claiming the standard deduction in a given year. 43. What is a Schedule C? A. A form used to report capital gains and losses. B. A schedule used by sole proprietors to report business income and deductions. C. A form used by corporations to report tax credits. D. A form used to report rental income. Do you know the answer? Correct answer, B. A schedule used by sole proprietors to report business income and deductions. Explanation. Option B is correct because Schedule C, profit, loss from business, is an IRS tax form attached to Form 1040. It is used by individuals who operate a business as a sole proprietor to report the income and expenses of that business. The net profit or loss calculated on Schedule C is then carried to the individual's personal tax return. Option A is incorrect because capital gains and losses are reported on Schedule D. Option C is incorrect because corporations use forms like Form 1120 and attach various other forms for credits, not Schedule C. Option D is incorrect because rental income and expenses are typically reported on Schedule E. 44. Which of the following is considered ordinary income property? A. Inventory held for sale in a trade or business. B. A personal residence. C. A work of art held for investment. D. Real estate used in a trade or business for more than 1 year. Can you guess the answer? Correct answer, A. Inventory held for sale in a trade or business. Explanation. Option A is correct because inventory is the quintessential example of ordinary income property. When a business sells its inventory, the profit is considered ordinary business income, not capital gain. Therefore, the property itself is classified as ordinary income property. Option B is incorrect because a personal residence is a capital asset, and its sale can result in a capital gain. Option C is incorrect because a work of art held for investment for more than 1 year is a capital asset that would generate a capital gain upon sale. Option D is incorrect because real estate used in a trade or business for more than 1 year is Section 1231 property, which can generate a capital gain. 45. What's the purpose of safe harbour provisions in tax law? A. To guarantee a refund to taxpayers. B. To provide protection against penalties for certain actions. If specific conditions are met. C. To allow taxpayers to pay a lower tax rate. D. To eliminate the need for tax audits. What do you think is the answer? Correct answer. B. To provide protection against penalties for certain actions if specific conditions are met. Explanation. Option B is correct because a safe harbour is a provision in a law or regulation that provides that certain conduct will be deemed not to violate a given rule. In tax law, if a taxpayer meets the specific requirements of a safe harbour provision, they can be certain that their tax treatment will be accepted by the IRS and they will be protected from penalties related to that issue. Option A is incorrect because safe harbours relate to compliance and penalty protection, not guaranteeing refunds. Option C is incorrect because a safe harbour does not create a special lower tax rate. It provides a clear way to comply with existing rules. Option D is incorrect because while following a safe harbour can reduce audit risk for a specific issue, it does not eliminate the possibility of an audit on other matters. 46. What is the kiddie tax? A. A tax on earned income for minors under the age of 18. B. A tax imposed on a child's unearned income over a certain threshold at their parent's tax rate. C. A tax on income earned by dependents of a household. D. A tax on scholarship income for minors. Do you know the answer? Correct answer. B. A tax imposed on a child's unearned income over a certain threshold at their parent's tax rate. Explanation. Option B is correct because the kiddie tax rules are designed to prevent parents from shifting investment income to their children to take advantage of the child's lower tax bracket. The rule applies to unearned income of a child above a certain annual threshold. This excess unearned income is taxed at the parent's marginal tax rate. Option A is incorrect because the kiddie tax applies to unearned income, not a child's earned income from a job. Option C is incorrect because the tax is specifically on the unearned income of certain children, not all income of all dependents. Option D is incorrect because scholarship income has its own set of rules and is generally not what the kiddie tax targets. 47. What is a private letter ruling? A. An IRS decision that applies to all taxpayers in similar situations. B. A court ruling that sets a precedent for tax cases. C. An IRS decision issued in response to a taxpayer's request about a specific transaction. D. A congressional ruling on tax law interpretation. What do you think is the answer? Correct answer, C. An IRS decision issued in response to a taxpayer's request about a specific transaction. Explanation. Option C is correct because a private letter ruling is a written response from the IRS to a specific taxpayer's request for guidance on the tax consequences of a particular proposed transaction. The ruling interprets the tax law for that taxpayer's unique set of facts. Option A is incorrect because this describes a revenue ruling, which is published by the IRS and can be relied upon by all taxpayers. A PLR applies only to the taxpayer who requested it. Option B is incorrect because a PLR is an administrative ruling from the IRS, not a ruling from a court. Option D is incorrect because PLRs are issued by the IRS, which is part of the executive branch, not Congress. 48. Which of the following describes Section 1250 property? A. Tangible personal property. B. Real property subject to cost recovery deductions. C. Intangible property. D. Inventory held for sale. What do you think is the answer? Correct answer. B. Real property subject to cost recovery deductions. Explanation. Option B is correct because Section 1250 property is the tax code's classification for any real property, such as buildings and their structural components, that is subject to an allowance for depreciation. This distinguishes it from Section 1245 property and land. Option A is incorrect because tangible personal property is generally classified as Section 1245 property. Option C is incorrect because intangible property is governed by its own set of rules, often under Section 197. Option D is incorrect because inventory is classified as ordinary income property, not Section 1250 property. (49) What is the step transaction doctrine used to prevent? A. Deferral of taxes for corporations. B. Taxpayers from disguising a single transaction as multiple steps to achieve favourable tax treatment. C. Multiple deductions for the same expense. D. Use of the cash method of accounting. Can you guess the answer? Correct answer. B. Taxpayers from disguising a single transaction as multiple steps to achieve favourable tax treatment. Explanation. Option B is correct because the step transaction doctrine is used by the IRS and courts to prevent tax avoidance. It collapses a series of legally separate but interrelated steps into a single transaction to determine the true tax consequences. This prevents taxpayers from inserting meaningless steps into a transaction simply to obtain a tax benefit that would not have been available if the transaction were done directly. Option A is incorrect because the doctrine is a general anti-avoidance rule and is not specific to corporate tax deferral. Option C is incorrect because other rules specifically prevent double deducting the same expense. This is not the purpose of the step transaction doctrine. Option D is incorrect because the doctrine has no bearing on a taxpayer's choice of an overall accounting method. 50. What is a topical tax service? A. A tax research tool organised by the Internal Revenue Code. B. A tax research tool arranged by subject matter. C. A tax research service that provides case law updates. D. A tax service that focuses only on international tax. Do you know the answer? Correct answer. B. A tax research tool arranged by subject matter. Explanation. Option B is correct because a topical tax service is a type of comprehensive tax research database that organises tax law, regulations, rulings, and analysis by subject or topic. This allows a researcher to find all relevant information on an issue like depreciation or charitable contributions in one place, which can be more efficient than searching by code section. Option A is incorrect because this describes an annotated tax service, which is organised sequentially by Internal Revenue Code section number. Option C is incorrect because providing case law updates is a feature of most tax services, not the defining organisational structure of a topical service. Option D is incorrect because while there are specialised topical services for international tax, the term topical itself refers to the subject-based organisation, not the scope of the content. You have reached the end of our first question set. For the free complete exam preparation, visit our website link in the description, where you find thousands more practice questions and comprehensive study guides. Thanks for studying with us today. See you in the next video.